Namaskar. Hello and welcome to P Guru's channel. I'm your host Sri Iyer. Today is Markets Day and Sridharji and I will be looking at the various markets. But more importantly, has there been an impact of the FTX collapse on the cryptocurrency industry? If yes, what could be the possible reasons? If no, where is it headed? Also, some more new revelations about the FTX missing money and all this and more. Let's welcome our co-host Sridhar Chetyalaji. Sridharji, namaskar and welcome to P Guru's channel.
Namaskar, good morning, good afternoon, or early good evening, depending on where you are, or early hours of the late night if you happen to be in East Coast or West Coast of United States. So very happy to be here
Sridharji,
for the market summary. Yep.
Sridharji, you are keeping a lot of nostalgic items such as the phone used by Alexander Graham Bell.
Yes, sir. I live in old ages, so I'm still an old thinker in a new wine bottle, if we have to use the phrase. So I
The wine remains the
constantly,
same.
that's working phone, by the way. It's not a doll. You pick up, you can hear the ringtone, and I can do zoom, zoom, zoom on that phone. So, so I remind myself
Wonderful.
that's where I started my life from, Sriji.
So let us start with equities, Sridharji. Can you put up the equities charts, please? Go ahead,
Yes, I
sir.
think, thank you, G. Thank you. The equities across the world showed a positive buoyancy on Friday based on two factors. One is retail earnings was pretty positive. There was also some rumors that potentially there may be a rate tapering that could come. And again, there's a positive news on the supply chain. So all that contributed to the uptick in the equities in the US and in the European markets. The Asia is because would have closed by the time the Asian news, US and European news flowed in. So you will see the uptick in the Asian markets on Monday morning. So that's on the US, Europe, and Asian. Next, we'll try to show you because you have been asking. Indian markets was down. The BSE and the Nifty 50 and Nifty 100 and Nifty 200. But again, you may see some positive buoyancy spilling over from the US markets when the markets open on Monday. But I think the key data point as far as the difference between the US and the West and the Indian markets is the Indian markets year to date, be it the BSE or the Nifty, has performed well. They are in the positive territory, whereas most of the other markets are in the negative territory. So whenever somebody correlates the growth of GDP as well as the general positive buoyancy, that simply means that that has to cascade itself into the markets. That's why you are seeing a positive movement despite the currency depreciation.
Sridharji, one quick question about Nifty. What do you think is the active listed number of trade stocks in India, sir? There are 5,000 listed stock. How many do you think are active on a given day?
Well, I would be very, very surprised. I don't have the data offhand to tell you, but I would be very surprised if it is, more than 100 stocks. The story is that it is very much a top end of the market. The small cap and mid caps tend to move slower, but it's really the large cap, especially in these types of economic circumstances. When the economic growth is cascading through the whole system, remember India is recovering from COVID. The service sector has just picked up, the manufacturing sector has just picked up. But I would say that 2022, 23 in the next year, as it spills in, you may begin to see more positive buoyancy across the stock strategy.
Yeah, that's why, because the Nifty 200 doesn't make sense. Anyway, let's go on to the bonds now. Bonds yields are a little bit up this week, sir.
The bond yields are slightly up, but on a relative basis, the bond yields are below 4%. If you remember that we were around 4.1, 4.2, the 10-year bond yields, that's come down. The bond was around 2.3 last week, and now it's about 20 basis points down. It's around 2.02. The uptick here shows basically a slight movement that happened on Friday. The Japanese 10-year as well is around the 0.244%. Remember, Japan is in tremendous contraction, almost in deflation territory. They have been for a considerable period of time. So if you want to put money in Japanese bonds and get no yield, then you should be It's a good place. I always tell India to borrow a lot of Japanese yen at low rates, and you get a very favorable cross rate ratio between yen and Indian rupee when you peg it to US dollar. So good to borrow in lot of Japanese, and you can still give 100 basis points as interest to the borrowing and to give some positive buoyancy to the GDP of Japan. So they're looking for anything that you can get, as long as you can borrow from Japan's region.
Let's take a quick look at the crude markets. Looks like the supply fears have receded. Plus, there are concerns about how much China will be able to take. So I think all these is resulting in a lower price for the crude, sir. West Texas
Yes,
Intermediate and Brent.
exactly. Brent was $94, $93. Now it has, but remember, these are futures. These are not spot rates. These are
Yes.
trading what it is trading in December, late December rate. So sometimes you see the asymmetricity of the markets in terms of various markets. So oil, crude is always futures. Currencies are spot. Yields, depending on whether it is 10-year or 2 months, 3 months, 6 months, you see the yield fluctuations. So that's generally the correlation. As well as the West Texas Intermediate crude is around $80. It's probably good time for India to get some WTI crude and basically churn it and export it to some of the other markets and make a buck, especially, and also earn some favorable foreign exchange net trading to reduce the deficit, trade deficit.
And let's now take a look at commodities such as gold. Gold has now again started to fall down. Sir, rates are going up. So why is the gold going down?
There is a fear of the deacceleration. Remember, we were at a pace where we were trying to get to very quickly to 4.5% from about 3.5% right now. So there, from 3 to 3.25 to 3.5%. We had two increases of 75 basis points. That's where we went from about 2% to about, 1.75% to about 3.25%. So there was another 75 basis point rate expected around the February of next year to push it to around 4. So there is a notion that the rates may be that the rate of increase in rates may deaccelerate. So there is a possibility as a result the gold prices are beginning to slacken a bit. Copper is purely because of very clear the world is reporting that there will be contraction in the economy in 2023. Whenever that happens, you see copper prices coming down.
A humble request to all of the viewers to like this particular video. We would like to have more people watch this program because we are about to enter the what I call as the whiz bang section of our program, because we're going to discuss what is happening on the FTX collapse and the reverberations thereafter. Let's go to the next slide, please. And on the currency markets, we have CJ, you can talk to it. It's a little mixed, which I'm curious why it's mixed.
Okay, US dollar rises because of a very hawkish Fed. And that when they say US dollar rises on hawkish Fed, but that simply plays that there is a whole bunch of people who came in and basically said, hey, we got to keep increasing the rates. There's a whole lot of Fed governors from Bullard to Baynard. Everybody have given their own views of what the market should be. So Euro, US dollar basically a little bit depreciated. That is the reason why you can see Euro to US dollar is around 1.0324. If there has been a true kind of an inflation, then you would see that it would be contracting more towards less than $1, one euro, less than $1 per euro. And that's the reason why you are seeing little contraction in the rates. The GBP and US dollar, because whenever you have austerity measures, Britain announced it is bringing about an economic change in the economic package. So you are now beginning to see that tax hikes coming in, my apologies, as well as expenses being cut down. So it is basically to shrink the balance sheet and reduce the constraints that the economy is facing. So you see the GBP USD dollar in the little bit of the appreciation territory. But the euro to USD and the euro to GBP, which are cross rates, you can see the corresponding correlations to be aligned. USD to Japanese yen, we were at the 150 territory, 152 territory. We have come down to the 140 territory, which is kind of the acceptable range. And there is a stimulus, another stimulus contemplated within the Japanese side.
Thank you, Sridharji. I have a quick question from a reader. It says that I said Indian markets we should not enter. Please advise. Vishwanathan ji, I'm not saying you should not enter Indian markets. What I'm saying is be selective. Let's say if you're investing in a special investment plan or systematic investment plan, SIP, make sure that the underlying stocks are well valued. And that is my concern. Again, Sridharji is echoing what I said. The market is very shallow. India's market is very shallow. 5,000 listed, but only 100 active. That tells you that the market is not very wide. And what happens is then the volatility is quite high. So you shouldn't feel too upset when things go up fast and also come down fast. Let's go to the next slide, please. Now we are looking at the US dollar. The US dollar is now coming off of the highs. It was what is this? What is DXY index, Sridharji, for our viewers?
It is called as the US dollar yield index, US dollar DXY index, which tracks the US dollar against a basket of currencies. So US dollar, if we go back to, we're just trying to give you data. This is a data that we picked up from 2016 to 2022. So you can see from 2016 to, this effectively reflects two things. The dollar appreciates when the rates are low. The dollar depreciates when the rates are low. When the rates are high, the dollar appreciates. The reason being everybody is rushing towards the dollar. So when the period 2017 to almost 2020, okay, let me come to 2019. The rates was around less than or close to 2%. 2019, there was a battle between Jerome Powell and President Trump when he moved the rates up from almost 1.5% to 2% and 2.25%. The economy had not sufficiently recovered and there was pressure placed, and the Jerome Powell then reduced the rates back to 2%, and you saw the dollar kind of going down. Then when you come to 2020, you saw that it slightly went up, and then the COVID came and it went down. And so it was at the 90 level, went up to 95. It sustained and remained below 100 much of 2021. Then in September, around September, it went up to about 114. That's the highest level that it reached in terms of the dollar to the rest. And that's when you saw all of the currencies take a hit, the appreciation of the dollar, and the discussions happened. Then now it has come down to about 106, basically because the rates have been adjusted and you are seeing a little bit of a contraction. So the story here is that whether they will stop or pause or they will continue. If they continue to sustain, by the time we come to 2023, you will see this dollar index go up. And this is the chart that basically shows the dollar and its correlation to the price and to the rate. Rate and price go hand in hand. When the rates rise, money moves to US dollar. When the rates fall, the money moves away from US dollar into other currencies. This is the correlation.
Sridharji, before we go to the next slide, can you go back to the previous slide, please? I have one question, sir. Now, from 114, it has come down to 106 in the last 1 week. So today, India's rates are around 83 or so to a dollar. Do you think it will also correspondingly go up by the same 8% to go to like 80 or something like that? Do you see that happening?
I think usually you find that there will be not a one-to-one correlation depending on the volume, etc., but there will be a small downtick if the depreciation stays. That is what you saw in the FX charts that we presented to you. as to what the euro, the British pound, the renminbi, etc. So you may see some positive movement when I say positive movement, it's negative if you're holding US dollar. It's positive if you're holding Indian rupee. Because if for 1 rupee, instead of getting 83, $1 instead of getting 83 rupees, I'm only getting 81 rupees. As far as the Indians are concerned, no. They would want to have at 75 rupees more dollars. So that is the correlation. It depends on which side of the market that you kind of focusing on. So if you're holding a US dollar, we may have to quickly exit from the currency and then move to something else. Shriji, this is the correlation that you see in the markets.
Thank you, sir. Next slide, please. Go ahead.
I think the other thing that we wanted to point out is that, we talked about the US dollar and the US dollar consequence. So if we look at that people like me who are in markets and banking, we kind of look at how do you allocate capital across the various market segments and what the underlying derailers can be. So, or underlying contributors can be dividends, earnings, currency, the multiples, the currency rates, etc. We look at the various drivers in calculating what the impact of the dollar and what the impact of the earnings. If the impact of the earnings is positive, you see the second chart moving up. If you're having a dividend, then dividend and earnings, then you have the first blue chart. Then if you have multiples, then that is the green chart. So the point here we are making is that if I'm investing in developing markets, ex-USA, you can see almost close to 10% the dollar appreciation contributes in terms of the derailer. That is the pulling my performance down. If I'm looking at the emerging markets, it's relatively smaller, but still it is, because the reason is that I'm a little bit benefited from that. Obviously, USA, there's dollar to dollar, has no correlation. All of them, Eurozone, Japan, UK, China operates on a very China to US dollar, renminbi to US dollar operates on a very narrow band because it's a manipulated currency. If I have to use that, it is listed by Treasury as a manipulated currency. It has been there forever. So hence you find that the toggle is very low. So the US dollar appreciation or depreciation has consequence to the earnings of the US investors as well, who do put money in other markets.
Thank you for that clarification, sir. It's a very important point because if somebody is looking at investing in various markets, this kind of gives you an idea as to how markets behave with respect to the dollar as the currency. Again, it underlies the importance of the dollar, but let's not say that because people don't like it when we say that. But that's the truth. Cryptos, sir, go ahead, sir. Let's talk about cryptos today.
Crypto, I think the key headline is that notwithstanding all the people, I call them, economists, Monday morning quarterbacks, czars, doomsday sayers, everybody coming in and making their view, if you are in crypto, get out. And if you are in this, to move out of the market. Well, there's been a little bit of a positive tick in Bitcoin. There's a small blip in the Ethereum, but generally speaking, the currencies have held stable. The chart that you see here on the down below is what we call as the market cap of the cryptocurrencies. If you take a look at the market cap of the cryptocurrencies from almost about 2015, now we are around 2022. What you saw is that it went up to about 2 trillion in 2021. That was the peak year. If you made money, you made money in 2021. If you had stayed stable from 2015 to 2022, if I have to use the venture capital notion, $250 billion to about $846 billion or $200 billion to 800, you are still in this period around the 3x, 4x mark in terms of the valuation. So one has to, what we call outliers. If you eliminate the outliers, it has kind of remained around that 1 trillion mark, not too far from it, but with a lot of positive momentum around, possible positive momentum around the two major currencies which make up the crypto market cap, which is Bitcoin and Ethereum. That's the read from here, sir. And when you, the next slide. Next slide. Is it in one slide or two slides? It's okay.
It's in
Two
two
slides.
slides, sir.
Two
Because
slides.
we wanted to show the numbers properly.
Okay,
So the
thank you.
top three are 2.46 trillion. 2.4 trillion is Apple. Microsoft is 1.78 trillion. Alphabet is 1.264 trillion. Next slide, please.
Yes.
Then Amazon is coming in at 983. That means this is Bitcoin is somewhere. It's between 3 and 4, sir.
Fifth largest within the tech index is
Yes.
is crypto, not Bitcoin. Crypto. Crypto as a class is the fifth largest. It's like Amazon has AWS, has marketing, has retail, so different classes of business. So if you take a market cap, crypto as a market cap, then within that you have Bitcoin, Ethereum, XBR, etc., etc. So you find that it is still the fifth largest segment within. On where is Tesla? It's at 560. So even if, for example, you are entering at this stage, in my view, entering the market at this stage, wait to see how things shape up. You still could be. My bet is that within 2 years, okay, we could be back to 1.3, 1.4, 1.5 trillion market cap on the crypto side. Is Tesla going to be going from 560 to 1 trillion or 1.2 trillion? I doubt. I doubt, based on the numbers
That's
that I
true.
see.
That's true. That's true. That's
Okay.
true.
So therefore, Tencent is in trouble. It needs money. Samsung 300 is opportunity, but when economy is contracting, is consumer electronics is one of the items where people will spend money. You can make your own analysis. The point that we're trying to make here is when you objectively look at the data, then the data tells you something different to sentiments and kind of hypocrisy and advocacy. Fraud is not a reflection of the market performance. Fraud is a reflection of how a specific entity within that segment has done or a company has done. A fraud in a bank doesn't mean the entire banking sector is full of fraud. That's exactly
Yes.
how
Yes.
people are projecting it incorrectly.
Yes, indeed. And I think we are done for markets. Next, take a look at next week, Sridharji. And then I have one question from a viewer that I'd like to ask, sir.
The markets next week is from a US markets point of view, which is, see, there are the reason why one tries to put US markets is doesn't matter whether it is currency, whether it is markets, whether it is yields, which is bond, or whether it is energy, all of them has a very closely tied correlatory effect to most notably markets such as India and markets such as the West, which is Europe and Asia. India is also trying to decouple from rest of the world with its own kind of supply and demand kind of dynamics. It has recalibrated, it's trying to decouple. So you see some positive performance on the Indian side. So the next week is going to be a lot of retail earnings data that is coming out in the US market. The general sentiments is that we are going to see consistent with the last, very positive across a range of sectors, both from the consumer discretionary to retail. We are going to see positive earnings. Even Dell possibly will be reporting better than earnings, analysts estimated earnings. So we will see a run from November to December as we get close to the end of the year in a positive. One other important data point is in 2022, we have seen the shift from tech economy, or what is called new economy, to old economy. New economy lost close to 30 percentage points. That is, the tech sector lost about 30% year to date in 2022. Whereas when you go back to the old traditional economies, the relative loss is only 8% year to date. So people are going back to the fundamentals, which is earnings, cash flows, and the spending patterns, and how effectively the companies are managing their balance sheets. This is the shift in trend. Even during COVID, it was the new economy that was performing. The old economy went into shelter. So that's the key observation that we'll be looking at as we run towards the year end next week.
Thank you so much, sir. And let's take some questions now. Tarun Balaji has a question. He wants to know, do you think the volatility in the Indian rupee is due to low liquidity in rupee denominated bond market?
uh, Low liquidity in rupee denominated, no, rupee denominated bond market is reflected in the local rates. The foreign, as far as the INR is concerned, it depends on the export import demand. If there is not a significant amount of exports, then you will begin to see the fluctuation in the in the dollar to INR ratio. But if there's very positive momentum on the on the export side, then you will find that the trade deficit. Look for the trade deficit. When you look at the trade deficit widening, but and then you find that you are tied to the prevailing market rates of the US dollar, which is why the finance minister said that it is nothing to do with my fundamentals, but it is everything to do with what is happening to the US dollar. I gave you an example. Whenever the rates go up, money moves to US dollar. And when money moves to US dollar, naturally the rate goes up. It has nothing to do with liquidity in your specific market. You have to deal with the currency appreciation and depreciation defined by that specific currency, which is the reason why I think India is trying to say that, wherever I can minimize using the US dollar, I'll try to minimize using the US dollar when I don't need to trade in that specific dollar, like ruble, for example.
And that there's one last question that just snuck in. Dhiren Vinod wants to know, why does the Indian currency perform bad compared to Turkish lira? Turkey has 80% inflation and Indian economy is doing well.
It's probably to do with the cross rates, because there's most of these what we call as the non-base currencies. Turkish lira is not a base currency. Most of them has to do with cross rates. And also there is no Turkish lira, listed in India and Indian rupee listed in Turkey. That's to address some of these cross rate issues. To give you an example, both renminbi and ruble got listed in each of those exchanges, so the companies can buy and sell in those exchanges. So you see this volatility because you have to go back to the cross rate. That's the reason why when somebody put up a question, which is to say you can have currency swaps and deal with it. Now, even if you have a currency swap situation, you have to go and define how do you get to your rate. Then you have to go to either LIBOR, which is in London, or you have to go to the global FX markets to come to what the cross-currency rate has to be, because there's no currency rates established between any two currencies, because there's no trading in those two currencies unless you establish a market. So that's my answer to that specific question. I have one observation before we wrap up, Sriji. We will probably take this up as another follow-on session, Sriji, with regard to FTX. The first reports that are coming out from the FTX, the CEO, the new CEO, is that the company performing well in many markets where it has licenses and where it has been operating. So the fundamental structure of the company is intact, except for except for the major incidents of fraud, which is isolated to one. So the company is working towards either recapitalization or fixing the company and making an exit. That means to sell to someone. So contrary to the economic pundits, the people who come and give lots of advocacies, I don't want to mention the name, one has to, if you are in people like us who are in markets and business, you have to study the balance sheet of the company and see whether there is true problem in the balance sheet, number one. Number two, whether the company is engaged in fraud right across the domains it operates in. That's number two. Number three, does the technology platforms that it operates, does it work and does it have volume? That's number three. That's the core business. And four, is it doing expense management and internal controls? Are they efficient? So the guy who has gone in, who did the restructuring of the bankruptcy, post-bankruptcy of Enron, is the CEO. So these are the initial reports that are coming out, contrary to the gloom and doom that people have talked about. But we will do a separate session with Sriji on what we have discovered so far and what our observations are. I just wanted to close with that, Sriji.
Absolutely, yes, we will do that, sir. Before we go, there's one last question again. One more question, sir. I just don't want to disappoint people who are watching so patiently. Aditya wants to know: do you think Fed raising rate this aggressively will lead to a point of no return for the economy to leading to a downfall?
We've been saying this all along, which is this is a supply side issue. You keep pushing the rate, the consequences of unwinding it is unknown. Right? When you create a disaster, how do you say I can fix the recovery from the disaster as 1 month or 2 months? I don't know how deep the disaster is. So the situation is that the answer to your question is if they continue to rise rates, it is going to be a problem because it will eventually lead to further contraction and credit squeeze. So, how deep that malaise is going to be difficult to quantify, but people have already factored in a 2023 recession based, notwithstanding the fact we are seeing uptick in Q4, reporting of the Q4 numbers. Remember, what we are getting is the Q3 data, not the Q4 data and the Q1 data. The interest rate increases has implications both in Q4 as well as in Q1. So, will it go to a point of no return? Please ask the British. They will tell you what the inflation is and what the economic issues that Britain is facing. Very soon, next to follow will be Europe. You don't need to ask the Japanese. Japanese will tell you that we really have a problem. We don't know how to get out of it. And my answer to good Japanese bankers is please tell Mr. Kishida to give $1 trillion loan to India at 1%. You add 1% to the GDP, India will put that $1 trillion to use and probably quickly accelerate to its $5 trillion or $8 trillion economy. Give them a 5-year loan on $1 trillion, they will know how to put that to work. And you still add 1% to your GDP at a concessional rate. I'm not just making this as a flippant observation. I have said this many times that the best way India can go up is to borrow from Japan, contribute to the Japanese GDP, and contribute to itself from an economic multiplier.
Absolutely, sir. I mean, there is a crying need for a very, well spread out metro network in every city that you can think of. Sir, in Mumbai, you've been a Mumbaiker for a long time. I'll tell you, there is this Worli Link Bridge. You've heard of Worli Link Bridge?
Worli Seaface Link, yeah. Worli
Seaface Link. Right? That saves you 15 lights, 1-5. If you assume an average of 2 minutes per light, you are saving 30 minutes right there. So this is just a road link. And imagine if there is, mesh connectivity in Mumbai. Sir, Parel area, you get lost there. I have waited for 20 minutes in one light, sir, because there's so much construction going on there, especially lower Parel. Oh, it's mind-boggling. You can never plan any meeting there. So just some of the difficulties of getting around in places like Mumbai, and then you can have subways 4 levels, 8 levels, whatever number of levels you want, and that Japanese engineering will go a long way. Mumbai will immediately pay back, sir.
Borrowing from Japan on a 10-year basis is the best solution. I know my good friend Mr. Gurumurthy will say we should not borrow from anybody. We have enough money in India. We'll create more money and liquidity in our bond market with Indian rupee. And, we'll continue to, because the bond vigilantes in India will come and say, hey, you are giving me a 6.5% yield. And tomorrow, you're going to cut off my yield. That means I have to serve my customers to whom I have to sell these government bonds at this type of a yield. If you take it from the Japanese yen at 100 basis points, I am done like a cookie. So therefore, no Japanese yen. Let's continue to float more in Indian rupee in the Indian market. So good luck and best wishes to India, Shriji.
Thank you, sir. I mean, we know a few things that we want to share our wisdom, and nobody's even asking us for it. But at least our hope is that people will listen and somebody benefits from this. Thank you once again, Sridharji, and we'll be back Tuesday, 6 p.m. IST. Once again, namaskar.
Namaskar. Thank you so much, Shriji. Thank you.